right, so we are recording. Thank you so much for being with us tonight, Jim, and our audience. If you have any questions for Jim, please feel free to put them right in your Q&A box if you'd like them shared out and asked. If there's anything that you would like to chat with other attendees about, or that needs my immediate attention, like maybe one of our audio is a little low or anything like that, please feel free to put it in the chat, and we're going to go ahead and get started. So thank you so much for joining us tonight, Jim. Jim is a certified senior financial advisor at Appella Capital in Marblehead, with accreditations through the College for Financial Planning. He is also a certified college funding specialist. And Jim has been visiting us here at the WML for over 10 years. So we're so happy to have Jim back for his annual visit. Thank you so much.
Thank you, Brittany. Yeah, first off, I do want to thank Brittany and the Wilmington Memorial Library for hosting tonight's event. It's greatly appreciated. Like Brittany said, I think this would have been my either 10th or 11th year speaking at the library. And we were scheduled to meet tonight face-to-face, but unfortunately that's not happening. We're limited to Zoom, which unfortunately isn't the same, but we'll do the best we can tonight. Again, a few housekeeping issues before we start. Like Brittany had mentioned, please feel free to use the Q&A section at the bottom of the screen. Feel free to ask any specific questions that you may have. I have carved out some time at the end of the presentation to answer as many of those questions as I can. Secondly, if you happen to get bumped out of the presentation, maybe due to a poor internet connection, you should be able to just exit out and then re-enter in using the same link that you used the first time around. Tonight's presentation is being recorded, so we will be following up over the next couple of days via email, sending you a copy of the recording. There's going to be a lot of information thrown at you here over the next 45 minutes or so. So my recommendation is to sort of sit back, relax, try to take it all in, because you will have an opportunity to go back through the presentation and sort of focus on any one particular area that you think is important. And then finally, I will be offering a free 20-minute phone consultation to anyone that attends tonight's presentation. So again, if any of you have specific questions on your particular situation, you will have an opportunity to reach out and schedule a consultation, and I will remind everyone at the end of that opportunity. So, Brittany, let's go with our first poll question tonight.
Right.
Hopefully. So I'm just curious, I always like to get a read on the audience. Can you please tell me what is the current year of your high school student? And Brittany, you're going to be able to give me the results of this?
Oh, yes, Jim. So sorry. I'm going to end the polling now, everyone. And then, Jim, you should be able to see it when I end the polling. But before I do that, let me just read them out. So it looks like we're at 2 of our participants are in grade 10, 2 are in grade 11, and 3 we're at, so 50% of our participants are in grade 12.
They're in grade 12, okay.
10, 11, and 12.
So class of 2021, the heat is on.
Oh, and there are those results. So sorry.
There you go,
and then
perfect. Perfect.
Stop the share. All right.
All right, so video off.
Okay, video off.
All right, folks, so here we go. So let's see. So a little bit about me before we start. I have been in the financial services industry for almost the past 30 years, and I've spent the majority of my career working with individuals providing independent, fee-only investment advisory and retirement planning services. Back when my daughter was a junior in high school, we decided to hire a college advisor to help us through the process. And after working with them for a short period of time, it became apparent to me pretty quickly that I had a lot of clients and friends and people I knew in the community that could benefit from this service as well. So I decided to become a lot more involved. So I am now entering my 13th year of providing college planning or financial aid consulting services. I've worked with close to 300 families over that period of time. And the more college planning I do, the more I realize that the college planning and retirement planning are really joined at the hip, because the decisions you make on how you put your kids through college or how you pay for school could have a huge impact on your own retirement. You know, the last thing you want to do at this particular point in your life is to make a major financial mistake where you end up jeopardizing your own retirement. And that's why I work in this market, to help help parents avoid that very situation. So here is our agenda for tonight's presentation. Like I said, it's about 45 minutes worth of material. First off, I'm going to introduce the different types of financial aid. We're going to introduce need-based and merit-based financial aid. Secondly, we're going to talk about the expected family contribution, or the EFC. We're going to talk about what that is, how it's calculated, and why that number is so important. Thirdly, I'm going to talk about improving your chances of qualifying for financial aid. So is there anything you can do before you file financial aid paperwork, or before your son or daughter puts together a list of colleges where they're going to be likely applying to? Is there anything you can do before that point to increase your eligibility for financial aid? Next, I'm going to talk about the financial aid application process. Talk a little bit about FAFSA, Css Profile, and some of the other forms and deadlines that you're going to be faced with. And then finally, towards the end, just a few minutes on paying the bill. Very, very rarely do I come across a family that has saved $250,000 to put their kid through school. Most families are trying to figure out, are we paying for college through income? Are we spending down savings? Do we need to borrow money? If so, where's the best place to borrow it from? So there's our agenda. So here we go. First off, there are two types of financial aid. There is merit-based financial aid, which is all based on the qualities of your student. And then there is need-based financial aid, which is all based on the finances of the family. So we're going to start off focusing on merit-based aid, because quite honestly, merit-based aid is pretty easy to understand. It shouldn't be foreign to many of you. But merit-based financial aid is a form of financial aid that you're all going to learn to love. Merit money is free money. It's gift money. Sometimes they'll call it a grant. Sometimes they'll call it a scholarship. Sometimes they'll call it the Presidential Award or the Dean Award. I don't care what you call it, as long as it's free money that doesn't have to be paid back. That's what we're all looking for. So merit aid is going to be awarded to the students based on the strength of their student resume. And student resume is a term that I just happen to use. Your student resume is your son or daughter's GPA, their SAT scores, their extracurricular activities, their essay, their entire application. And the stronger that resume, the more marketable the student is. And colleges are going to compete for kids with strong resumes by offering merit money, free money that doesn't have to be paid back. So what are colleges looking for? Now, these items are important not only from an admission standpoint, but also from a merit-based financial aid standpoint. First and foremost, good grades are still the biggest single factor. So a good, strong GPA. But coming in closely behind is curriculum planning. So colleges are looking for high school students that have been challenging themselves academically throughout their high school career. So hopefully your son or daughter has been doing so by taking some honors classes, by taking some AP classes. A college would prefer to see a student get a B in an honors or an AP class than an A in a CP1 class. So colleges are looking for kids that have really been challenging themselves. Secondly, is standardized test scores. So again, this is the only common method of a lot of these colleges to compare the academic abilities of a high school student from Wilmington to a student from Dallas, Texas, to a student from Jacksonville, Florida, through these standardized tests. Many schools will offer merit-based scholarships based on SAT and ACT scores alone. Now, due to COVID, as you know, standardized test scores, a lot of schools are now going test optional. So as we head into the 2021 admissions process and financial aid decision-making process, we're kind of in uncharted territory. So we're not 100% sure at this point how colleges are going to deal with this. But I will say, if your son or daughter is a good test taker, I would encourage them to continue to take those tests and submit those tests because it could equal some pretty substantial merit awards. Next, colleges are looking for leaders, especially the elite schools. So in addition to good grades and good SAT scores, colleges are looking for kids that have taken a leadership role in high school. So maybe your son or daughter has started their own community service organization or started a club at the high school level. Don't make the mistake of having your son or daughter just get involved in 8, 9, 10 different organizations to pad their resume. Colleges look right through that. They would much prefer to see a student really get involved, take a leadership role in 1 or 2 organizations. Next, the colleges are looking for solid essays and interviews. This is an opportunity for your student to separate themselves from the competition. You know, the college essay gives them the opportunity to explain to the college what can they bring to that campus that no one else can bring, right? The interviews, if your son or daughter is a good communicator, comfortable around adults, I would strongly suggest you take advantage of the interview. So if the college does offer interviews, make sure when you're scheduled for the campus visit, hopefully at some point, that you schedule an interview where you can get in there and really show your worth. And then finally is athletics. Now, I'm not talking about the Division I student athlete here. Those kids have typically been discovered by a Division I program by their sophomore year. I'm talking more about the student athlete who wants to continue to play sports at the college level, D2, D3, even club sports. There are some things you can do to separate yourself from the competition, to connect with coaches, to potentially be offered some merit-based aid. Now, they're not going to call it an athletic scholarship at Division II or Division III, but going back to what I said earlier, I don't care what they call it, as long as it's free money, I'm interested. So that's merit money, right? Pretty straightforward. Now, 2 important things to know about merit. First off, every student or every family is eligible for merit-based financial aid. You could be making $1 million a year of income. You could have $10 million in the bank. Does not matter. Every student is eligible for merit aid based on their academic achievements. Second important thing to know about merit is not all colleges offer merit-based financial aid. So the last thing you want to have happen is to have your son or daughter apply to 8 to 10 schools and then find out after the fact that none of those schools even offer merit-based financial aid. So you need to do a little bit of research there. Again, so that's merit, pretty straightforward, all based on the academic achievements of the student. Second type of financial aid is called need-based financial aid. And again, need-based financial aid is all based on the finances of the family. And here is the formula they use to determine if your family is eligible for any need-based aid. COA, which stands for the cost of attendance, minus EFC, which stands for the expected family contribution, and then the difference is need. So let's say hypothetically that your student applies to a school where the cost of attendance is $50,000 a year. And you file your financial aid forms and they say your expected family contribution is $30,000 a year. So 50 minus 30 means you're eligible for $20,000 worth of need-based financial aid in that scenario. Now let's say that the family's EFC, like I said, is $30,000 a year, and they apply to one of the Massachusetts state schools, and let's just say the cost there is $30,000. So you plug the numbers in, 30 minus 30 means you're not eligible for any need-based financial aid in that scenario. So just because you're eligible for need at one school doesn't necessarily mean you're eligible for need at all schools. The other point I like to make here are there are 2 different methods of calculating this expected family contribution. There's something called the federal methodology, and then there's an alternative methodology called the institutional methodology. So if the school only requires the FAFSA, and we'll talk about financial aid forms in just a little bit, but if the school only requires the FAFSA, that's the federal methodology, and they're doing their calculation one way. There are about 400 private schools that require an additional form called the Css Profile. They do their calculations the institutional method or a different way. Again, we don't need to get caught in the weeds too much here. I just think it's important at this point for you to understand there are two different ways to calculate this EFC. So let's take a look at the sticker price at 5 well-known Massachusetts universities. These are the current school years. So cost of attendance is not just tuition, it's room and board and living expenses, etc. My daughter had actually applied to Arizona State for some unknown reason, and they actually included round-trip air back and forth twice a year into their cost of attendance. So the school will tell you what their cost of attendance is. Again, here's 5 well-known Massachusetts schools. Harvard and Northeastern, a little under 76,000. Stonehill at 65. UMass Amherst looking like a real bargain here at 32. And then Worcester Polytech, a little under $72,000. Again, folks, this is per year, right? So these numbers times 4, times how many kids you have, these numbers can get pretty scary. Chances are you may end up spending more putting your kids through college than you actually did in buying your home. All right, let's go to the second poll question, Britt. Nope, here we go. What is the most difficult college in the country to be admitted to in 2019? Curious to have your thoughts here. Which school is the most difficult school to gain admission into? Give you a second to answer. Very good. 60% of them got the answer correct. Stanford at a 5% acceptance rate last year. The other 3, MIT, Harvard, and Princeton, are all at about 6%. So think about that, right? 1,000 kids apply to Stanford. 1,000 kids and only 5% gain acceptance. All right, so let's turn to the second determining factor in the need-based aid calculation. So COA is the cost of attendance. EFC, again, is the expected family contribution. And this number is based on your family's specific financial situation. This is going to be a number that is unique to you. So what they'll do is they will take a look at parent income, parent assets, student income, student assets, the age of the parents, the number of members in the family. It's actually pretty complicated to come up with this EFC number. But the good news is the Department of Education has been working at simplifying this formula over the last few years. And here's their most recent flow chart. I usually get laughs when I'm in person, but it's just not the same on Zoom. Unfortunately, the folks that bring us the financial aid system are the same folks that bring us the tax code, and that happens to be Congress. It's not clear, not easy to figure out. So what I'd like to do in this next slide is just highlight some of the key components to what goes in to calculating this expected family contribution. So if we start up in the upper left corner, parents' income. This is by far the most important component of this EFC calculation. So if you pull out your most recent tax return, your 2019 tax return, you're going to look at line 8B, which are adjusted gross income. So that's going to be the starting point. They then subtract the living allowance, income taxes paid during the course of the year, contributions into Social Security, and they take that net number and they multiply it by anywhere between 22 and 47%. Now, this is a graduated system, so the larger that net number, the closer you get to 47%. And unfortunately, you get there pretty close, but pretty quickly. So again, they're going to look at parent income, the most important component. Next, they're going to look at parent assets. And on the next screen, we'll talk about what assets count and what assets don't count. So for any asset that is countable, they're going to count that at 5.64%. So again, if you have $100,000 in a bank account, your EFC is going to increase by about $5,600 by having that $100,000 in an assessable asset. Next, they're going to look at student income. Now, the good news here is they give us a safe harbor. They allow students to earn up to $66.60 per year before it starts to have a negative impact on EFC. Now, this doesn't come up all that often. Very rarely do I come across a high school student that's earning more than $66.60. But I do like to bring it to your attention, because once your son or daughter gets into college and they start working, you know, maybe a good summer job, or they're working off campus during the course of the year. Once they get into college, it's not unusual for the kids to earn more than this number. So hypothetically, if your son or daughter earns $10,000 during the course of the year, they're not going to count the first $66.60, but the next, you know, approximately $3,300 is going to get nicked at 50% of that number. So your EFC is going to go up on that scenario. And then the last thing I'll mention are student assets. So if any of your kids have money in local bank accounts, in a UTMA or a UGMA account, where the parent is listed as the custodian and the students are listed as a beneficiary, those student assets get counted at 20 to 25%. So again, if you have $10,000 in a custodial account for your son or daughter, your EFC number is going to increase by about $2,000 to $2,500 as a result of that student asset. So you may notice right here, parent assets are counted much more favorably than student assets. Now, don't go racing out tomorrow pulling all the money out of your student accounts. At the end of the day, it may not make much of a difference, but I do think it's important for you just to understand how those assets are treated differently. So let's talk about what assets count and what assets don't count. First piece of good news I have for all of you is that retirement accounts do not count against you in the EFC calculation. So 401ks, 403bs, IRAs, Roth IRAs, simple SEPs, those accounts are not going to work against you in financial aid. Personal property, so cars, boats, jewelry, will not count against you. Annuities, if anyone owns an annuity that's in the accumulation phase, meaning you're not taking money from the annuity, is just growing, tax deferred in a retirement-like account, that also will not work against you. Life insurance. So as you may know, life insurance comes in several different forms, several of which have a cash value component, whether it's a whole life, a universal life, or variable life policies. Again, those cash values do not have to be reported on FAFSA. Your personal residence. So if you remember earlier, I talked about the different methodologies of computing the EFC. There was the federal and there was an institutional methodology. So this is where things start to differ a little bit. So if your son or daughter is applying to a school that only requires the FAFSA, they are not going to count the equity in your primary residence as an asset. I'll say it again. If your son or daughter is applying to a school that only requires the FAFSA, they are not going to count your home equity in your primary residence as an asset. If they are applying to one of those 400 private schools that do require the CSS profile, chances are they are going to count home equity in your primary residence as an asset. Same thing with sibling assets. So on sibling assets, on the FAFSA, you are only reporting assets in the name of the student. CSS profile wants to know the accounts of all your children. And if you happen to be a business owner with less than 100 employees, again, FAFSA, do not have to report it. Some of the private schools, you will. So much of the information that you provide on your financial aid forms, which we'll talk about in just a little bit, on FAFSA and CSS profile, are tied directly to your tax return. Again, I said earlier, the most important number on this tax return is line 8B, your adjusted gross income. And if you happen to be a W-2 employee right? And most of that line 8B is earned income on line 1 of your tax return. There's not a whole lot you can do. But there are some things that happen between line 1 and line 8B that I just want to bring to your attention. So there are things like distributions from IRAs that will increase your line 8B. There are things like capital gains. So if you happen to take capital gains in 2019, likely that it increased your line 8B. So the larger line 8B is, the less financial aid you're going to be eligible for because your EFC is going to be higher. Now, again, for those of you that have seniors, it's too late for that, right? Your 2019 taxes have been submitted, completed. Line 8B is what it is. But for those of you that have younger kids that will be using future year tax returns, you want to be careful. You want to try to minimize line 8B as much as you possibly can. So back in 2015, the Obama administration made a significant change to the FAFSA. And the significant change was they are now using prior years when it comes to filing FAFSA. So if you have a 2021 student, they will be using your 2019 taxes to determine aid eligibility. So it's prior, 2 years prior to the time you start college. So for those of you that have juniors, 2022, they will be using this year's tax return, 2020. For those of you that have sophomores, 2023, they'll be using your 2021 tax returns, right? So this is a great example on the importance of starting the college planning process early. So for those of you that have sophomores, juniors and sophomores, there still may be an opportunity for you to do some income planning to potentially lower that line 8B and make yourself eligible for more need-based financial aid. So I'm going to encourage each and every one of you to determine what is your EFC, right? You want to know what that expected family contribution number is because you want to know whether or not you're going to be eligible for any need-based financial aid. So once you get that EFC number and you do the calculation, right? COA minus EFC equals need. Every family is going to fall into one of these 3 categories. Category 1, there are those families that will qualify for 100% of need-based financial aid, regardless of where you apply to school. So if you apply to a school that costs 30 grand, you're going to be eligible for 30 grand. If you apply to a school that costs 70 grand, you're going to be eligible for $70,000. Another way of saying this is this family has a 0 EFC. Now be careful what you wish for. In order to be eligible for a 0 EFC, your adjusted gross income has to be $24,000 or less. But if it is, again, from a financial aid standpoint, congratulations, you're going to be eligible for a ton of need-based financial aid. Now, there are some of you that are going to fall into category 2, those families that will qualify for a portion of need-based financial aid. And that's the example I was using earlier, right? The cost is 50, your expected family contribution is 30. That family is eligible for $20,000 worth of need-based financial aid. And then the third category are those families that won't be eligible for any need-based financial aid. They either make too much, they have too much, their EFC may be $90,000. So no matter where you apply to school, that EFC number is going to be larger than the cost of attendance, which means you're not going to be eligible for any need-based financial aid. Everyone, you need to know which category you fall into here if you're looking to minimize your out-of-pocket cost at each of the colleges. So let's assume that you fall into category 1 or category 2, where you are going to be eligible for some need-based financial aid. At that point, you need to do some additional research. You need to take this research one step further. You need to know for each of those schools what percentage of need do each of those schools meet. So again, I'll go back to my example. 50 minus 30 equals 20. So the family's eligible for $20,000 worth of need-based aid. There are some schools that will meet 100% of need. So if you have a $20,000 need, they're going to give you a $20,000 financial aid package. There are other schools that maybe only meet 50% of need. So if you have a $20,000 need, they're going to offer you a $10,000 financial aid package. Who do you think is responsible for the gap, the other 10? You are. So your EFC just went from 30, now you've got that unmet need of 10, so now you're paying 40. So for each of the schools on your students list, you want to know what percentage of need each of those schools meet, and what percentage of that is gift money, and what percentage is self-help. Again, gift money is free money. Self-help, I'm referring to loans and or work study. So the last thing you want to have happen is find out you get, a great financial aid package and all of it comes in the form of loans. So here's a quick case study that I put together, and I think it's a good example on why you should never pay attention to the sticker price of the school, especially if you're eligible for some need-based aid. So here's a family. They do their EFC calculation, and the colleges expect them to come up with $10,000 a year. So their EFC is $10,000. So let's take a look at the financial aid differences between a private school and a public school. So if we look at the private school in the upper left, we've got the cost of the school is 50, minus your EFC of 10 means you're eligible for $40,000 worth of need. The public school costs 30, your EFC is 10, but you're eligible for $20,000 worth of need-based aid. Now, let's take a look at how each of these schools delivers financial aid. The private school, maybe because of the size of the endowment, they meet 100% of need. So you have a $40,000 need. They're going to give you a $40,000 financial aid package, 80% of which comes in the form of a gift, 20% comes in the form of loans and or work study. Now the public school, chances are they don't have the endowment that the private school has, and they only meet 60% of need. So you have a $20,000 need, you're going to get a financial aid package worth of $12,000, which means it's an $8,000 gap. Half of the money or half of the financial aid is going to come in the form of gift, the other half in self-help. So what do you actually end up paying at each of these schools? Again, with the private school, you're responsible for that EFC, so you're responsible for the $10,000, but they are giving you a $40,000 financial aid package, 32 of which comes in the form of gift money, 8,000 comes in the form of self-help. Then you look at the public school, the EFC is, your out-of-pocket cost is $18,000 a year, 6,000 of which is in the form of gift, $6,000 is in the form of self-help. So it actually ends up costing you $8,000 more out of pocket to go to the public school versus the private school. So folks, don't make the mistake of just taking a look at the sticker price of these schools and determining that your son or daughter should not apply to a school just based on cost. You really need to have a full understanding on, are you going to be eligible for need, and then how do each of those schools deliver financial aid. So let's bring this full circle. First off, two types of financial aid. There's need-based financial aid, which is just based on the formula we talked about. And then there's merit-based financial aid, again, which is all based on the qualities of the student. Last sentence here is very important under the merit-based aid description. Proper positioning maximizes your student's eligibility for aid. So what does that mean? So first off, merit-based aid most likely is going to come directly from the colleges themselves. Private universities have endowment funds above and beyond the federal and the state funds that are available. And they are going to award those funds to students that they're looking to attract to their university. Very important to know that merit-based money is awarded on a first-come, first-served basis. You do not want to miss a deadline, either on the application side or on the financial aid side. If you miss that deadline, you run the risk of, by the time they get to your application, the pool of merit money has already been distributed. Okay, so very, very important. You do not want to miss an admissions or a financial aid deadline. And many colleges will give preferential packaging to students who are in the top 25% of the applicant pool. So what does that mean? Let me explain with a quick description here. So let's say your son or daughter is a good student, good solid student, 3.5 GPA. Let's say they have 1200s on the SATs, and they have always dreamt about going to Boston College. So they apply to BC, and as you're doing your research, you notice that last year's freshman class, the average GPA was 3.75. Your students is 3.5. The SATs are 1,300. Your students are 1,200. Are they going to be in the top 25% of the applicant pool? Chances are no. Now, if you take that same student, but instead of applying to Boston College, you apply to, hypothetically, Fairfield or Stonehill or Quinnipiac, and you do the same research, right? And you may find out that the average GPA of last year's freshman student was 3.25, and the average SAT score was 1,100. Now, all of a sudden, your student looks like a rock star. And that school, that college, wants to attract your student to that school because they're in the top 25% of the applicant pool by offering merit money, free money that doesn't have to be paid back. Okay, we're going to transition here. We're doing our time. We're doing good. We're going to talk about everyone's favorite subject, financial aid paperwork. So again, FAFSA can be found at fafsa.gov or fafsa.ed.gov. This is the free application for federal student aid. Notice that free word, that first word is free. The reality is, folks, you do not need to pay anyone to do the FAFSA. It's pretty straightforward. They've really done a nice job of simplifying the application process on FAFSA. It cannot be filed before October 1st. As a matter of fact, it's not even available until October 1st. Every year I get a call from a client all proud of themselves in the middle of August telling me that they've already submitted their FAFSA. And I have to break the bad news of saying, unfortunately, you filed last year's FAFSA, you're gonna have to do it again after October 1st. Now, FAFSA is not just for freshman year, it must be filed every school year. Just like your taxes, your income changes every year, your tax return changes every year, your FAFSA is gonna change every year as well. Everyone must fill out this form in order to get aid. And I hear this from parents all the time. They tell me that, I've done the EFC calculation. I know I'm not going to be eligible for any need-based financial aid, so I'm not even going to bother. I would encourage all of you to go through the application process with FAFSA. It is going to make you eligible for the direct student loan, which I will talk to you in just a bit. So you'll be eligible for the most attractive loan in the market. You also will not be eligible for work study if you do not file FAFSA, and you cannot appeal your financial aid award if you do not file FAFSA. So there are reasons to do it. As a matter of fact, there are some schools that will not offer you merit-based financial aid if you do not file FAFSA. So get over it, everyone. You got to deal with it. The second form you need to be aware of, again, is called the Css Profile. You can find Css Profile at collegeboard.org. Chances are your son or daughter already has log-on information here because this is where they register for their SATs or their subject tests. I will tell you, this form is much more intrusive than the FAFSA. They're going to ask about home equity. They want to know more details on your income and your assets and your expenses. And there are costs associated with Css Profile. It's $25 for the first school and then $16 for each additional school as well. I usually tell folks, if you're just dealing with the FAFSA, you can probably get through it on a glass of wine. If you got to deal with Css Profile, you're dealing with the whole bottle at that point. And the other forms, some schools have their own institutional forms as well. So in some cases, I'll use UPenn as an example. UPenn requires FAFSA, Css Profile, and their own institutional form. Endicott here in Beverly, as an example, requires FAFSA, does not require Css Profile, but does have their own institutional form. So you want to make sure you go to each of the school's websites and get a very clear picture on what forms are required and the corresponding deadlines at each of these schools. Are there any additional forms? If you happen to be a business owner, chances are the school may require a business supplement form. And if anyone here is divorced or separated or remarried, we could do an entire presentation on that scenario. Obviously, I don't have enough time tonight, but I do want to spend just one slide on divorce, separations, remarries, because it does impact so many people. The most important thing in a divorce or separation is how the colleges define the custodial parent. So whichever parent the student is spending more than 50% of their time, that is the parent that is responsible for filing financial aid. Now, if it is a straight 50-50 split, the tiebreaker will be which parent provides the majority of their financial support. Now, there's a lot of gray area here, so there may be some opportunities to do some planning. But again, the most important thing to determine here is who's the custodial parent. If the student is spending more than 50% of their time with mom, hypothetically, then mom is the one that's responsible for filing financial aid. The last point here is important, that if you are in a divorce or separation situation and your son or daughter is applying to schools that require the CSS profile, chances are the schools are going to require that non-custodial parent to file a non-custodial CSS profile as well, where they're reporting their income and their assets. Honestly, it gets pretty complicated here in divorce and separation situations, but again, I just wanted to give you a flavor for if this is your situation, what you're looking at. Now, most of the need-based financial aid, or the majority of the need-based financial aid, will come directly from the federal government. So both Pell Grants and Supplemental Education Opportunity Grants, they are both need-based grants. So if you have a low EFC and you are offered one of these grants, you're going to be very excited, right? Because it's a grant. This is free money from the federal government that they are going to give you to help you get your kids through college. College Work Study is also a federal program. I happen to be a big fan of College Work Study. Studies have shown that kids that are involved in College Work Study get better grades and actually get quicker placement for a full-time job coming out of college. And I think a lot of it obviously has to do with the time management skills that come along with that. And I hear from parents all the time, they don't want to burden their kids with working while they're in college or on campus. You know, a full-time course load for many of these kids is like 15 hours a week, 1-5, not 5-0, 15. So there's definitely 6, 8, 10 hours during the course of a week where your son or daughter can work on campus, work in the athletic facilities, swipe cards in the cafeteria, work in the library, whatever it is, to actually earn a paycheck while they're at school. Federal direct student loans. These are the direct subsidized and unsubsidized loans. These are the loans I referred to just a couple of slides ago. These are by far the most attractive loans in the college space. These used to be called Stafford loans back in the day. Now they're called federal direct student loans. I'll give you the good news. So the good news is these loans are in the name of the student. So the parents are not affiliated or associated with these loans at all. They're at a relatively low interest rate. They just announced rates a couple of months ago. The current rate for the upcoming year is 2.75%. And it's a deferred loan. So your student does not have to worry about paying this loan back until they're 6 months out of college. Now, that's the good news. The bad news is the most you can get as a freshman is $5,500, and then $6,500 as a sophomore, and then $7,500 as a junior and a senior. You add it all up, it's $27,000 over a 4-year period. Again, this is the only loan that your son or daughter is going to be able to get on their own. So again, if you're looking to borrow money somewhere, If you're looking at some sort of shortfall, this is going to be the first loan for you to tap. The other loan I'd like to mention, again, this is a federal loan, is called a plus loan. So again, this loan is a double-edged sword. This loan is the sole responsibility of the parent. So the student is not associated with this loan whatsoever. It's a federal loan. Current interest rate is 5.3%. The good news on a plus loan is you can borrow as much as you need. The bad news on the plus loan is you can borrow as much as you need, right? So if you get your final bill and let's say you need to come up with $30,000 and you don't have $30,000, you can borrow the entire 30 on a federal plus loan. So you apply for the loan, the federal government will send the 30 directly to the college, you are paid in full, and then you start paying back the loan provider. Now you can defer it. I would suggest you start making payments right away because these loans can get pretty ugly pretty fast. The challenge becomes, you may find them somewhat manageable freshman year, maybe sophomore year, but if you're borrowing 30 a year, by the time you get to junior year, these monthly payments, which maybe started at $300 a month, are now at $1,200 or $1,500, and now you've got a second kid coming. So just be careful. Plus loans are a great solution. Typically, I recommend them as a stopgap, but you want to be careful. You don't want to take out too much in plus loans. There are also some state programs here. I'm not going to spend much time on this slide. We're getting a little bit tight on time. I will refer you to the website at the bottom for residents of Massachusetts, osfa.mass.edu. I would go to that site. Some of you may be familiar with the John and Abigail Adams Award. These are state awards that are available to all college kids. It's just important to know that you only have to be a resident of the state of Massachusetts. You do not have to go to school in the state of Massachusetts. It just has to be your primary residence in order to be eligible for these. And the last thing I want to mention is the appeals process. Many families are surprised that they actually have an opportunity to try to negotiate a better deal for themselves. So this will typically happen during the spring, the upcoming spring for the class of 2021. So the way this will play out is your son or daughter will apply to schools. You will submit all the required financial aid documents. They will get accepted. And then shortly thereafter, you will receive a financial aid award. There may be an opportunity for you to go back to your son or daughter's top choice and try to appeal or try to negotiate for a better deal. But there has to be a reason for it. You can't just say that I can't afford it. The two most common reasons are a lot of colleges will compete with rival schools. So you see this with Boston University and Northeastern as an example, right? They're trying to attract the same type of student. They're in the same geography. Other schools like Michigan and Wisconsin, as an example, they're in the same conference. So if the schools typically are competing on the football field or on the basketball court, they're likely to be competing in the classroom as well. So again, even if your son or daughter is not interested in going to Wisconsin, their top choice is going to Michigan, I'd encourage you to apply to Wisconsin as well, because you maybe have an opportunity to use that award as leverage down the line. The most common reason to appeal a package, and this is going to be really, really prevalent next year, is this is an opportunity for you to explain your special circumstances. So, if COVID has had a financial impact on your family finances, this will be the opportunity, or this will be the chance in the process for you to explain your situation. You're not doing it up front. If you call a school and tell them that your family is under financial distress because of COVID, they're going to tell you to go through the natural financial aid process, to file FAFSA, to file Css Profile, and then you circle back with them once they've been accepted to explain your situation. And hopefully the college will step up and deliver a better financial aid package for you. So I know I threw a lot at you here over the last 50 minutes or so. Let me finalize or wrap things up with this. I hope if you learned one thing tonight, it's this: you need to be proactive. This is not something you want to figure out as you go. You know, every year I get a handful of calls from parents that were sort of winging it, trying to figure it out. And by the time they get to junior year, they've either run out of money or been declined on a loan and aren't really sure what to do. You know, I would encourage all of you, you now have an opportunity to really be proactive and to put a plan into place, not deal with it 1 year at a time. You know, this is going to be a 4-year commitment for one student, and some of you may have more than one. You want to have a plan in place to get all your kids through school without jeopardizing your own retirement. I would say for each of you, for those of you that have a relationship with a trusted advisor, you want to reach out to that advisor tomorrow, and you want to schedule an appointment, and you want to know, what is my EFC, and is there anything I can do to lower it? If your advisor cannot help you, you need to do one of two things. You need to either figure this out on your own, or you need to find someone that can help you. Maybe you met someone tonight that could do so. Next, the other thing I'm going to ask you each to do is take a step back, take an honest evaluation of your son or daughter, and determine their chances of obtaining merit-based financial aid. If they're a good student, okay, there are some opportunities for you to leverage their accomplishments by applying to schools where they're likely to be offered merit-based financial aid, right? In the top 25% of the applicant pool. If you know going in that you're not going to be eligible for any need-based aid because your EFC is too high, and you apply to schools where you're likely not to be offered merit, well, I hate to tell you this, but congratulations, but you're going to be paying full sticker price. No need-based aid, apply to schools that don't offer merit. You get in, you're paying full price. Next thing you should figure out is your college pre-approval, right? How much can I afford? I think a lot of parents make the mistake of looking at this backwards, right? I would suggest to all of you that you approach college just like you approach buying your first home or any home. You know, if you're going to buy a home, you would work with a banker or a mortgage broker. They would evaluate your income and your assets, and they would tell you how much of a mortgage you can afford or how much house you could buy. So if they tell you you can afford a $600,000 house, you're not going to waste your time out there looking at $1 million houses, right? You're going to focus your time on $600,000 houses. I would suggest to all of you that you should take the same approach with college. You should know what you can afford before you start to visit schools. You also want to evaluate funding strategies, right? How am I going to pay for this? Am I paying from income? Am I paying from assets? Do I need to borrow money? And if so, where's the best place for me to borrow it from? And then finally, how does college planning fit into your overall financial plan? You know, like I said at the beginning, the last thing you want to do at this point is to make a major financial mistake where you end up jeopardizing your own retirement. Again, that's why I'm in this space, to help parents avoid that very situation. We want to be able to get your kids through school, get them a solid education, and still be able for mom and dad to have a comfortable, successful retirement. So that is it for tonight. Again, I will be offering, as a courtesy to anyone who attended tonight's presentation, a free 20 to 30 minute consultation to discuss your situation in a private setting. We will be sending out an email over the next day or so with a recording of the presentation. And in there will be an opportunity for you to schedule a consultation with myself. I would suggest all of you take advantage of it. And again, that's all I have. Thank you all for attending. Brittany, if you're there, do we have any questions?
I'm here, Jim. I'm so sorry. Did I miss a poll question?
No, I missed the poll question.
Oh, well, we still have time if you'd like.
No, we've gone over. That's okay.
Let me see. I'm not seeing any questions in our Q&A box. Please feel free to enter some. We still have a few minutes. Or put them in the chat if that's easier.
Let me answer the most common questions that I get. So quite often people ask me about 529 plans. So one of the most common mistakes that I see is that parents will count 529 plans as a student asset when in fact 529 plans are parent assets. right? So when you get your 529 statement, you'll see your son or daughter's name on there. So parents just assume it's their asset. The reality is the student is the beneficiary and the parents are the owner of that asset. So when you're reporting assets, make sure you are reporting 529 plans as parent assets, not student assets. The second most common question I get has to do with having more than one kid in school at the same time. So again, when it comes to calculating the EFC, if you have 2 students in college at the same time, your EFC will get split in half. So again, if you had a $30,000 EFC with 1 in school, that means with 2 in school, you'll have a $15,000 EFC for each of the kids, which means you'll be eligible for more need-based aid during those overlap years.
Oh, we have a thank you from one of our participants. And I'm still not seeing anything in our Q&A box.
Okay.
Jim, I think you just did a very thorough job.
Terrific. All right, everyone. I hope you enjoyed it.
Yes, I think so. Thank you so much, Jim, for being with us tonight, and to all of our attendees. As Jim said, I will get an email out to all of you who are registered tonight from Jim. Please be in touch if with Jim to follow up. His email will be in the email I'll forward you. And to anyone on Facebook Live, we will also get that information out to you if you would like to email me. My email is btuttle@willamlibrary.org.
Thanks,
All right.
Brittany.
Thank you so much, Jim.
Good night,
Have
everyone.
a great night.
You too. Bye-bye.
Bye-bye.